Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's window company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, M&T Bank, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, the Moynihan Group, Margolin Weiner and Evans LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, the Wickoff Group.
Hello, my name is Michael Stoller. There's a market out there. There are people from around the world, insurance companies, individual investors. People like to invest in real estate. And there are companies called real estate investment funds, equity funds, hedge funds, private partnerships. And today I've assembled four leading individuals responsible for investments in this market today. My guests today include Scott Schwartz, co-head of Marathon Asset Management's Real Estate Funding. Rob Varadian, Senior Managing Director, Golden Tree Partners, correct?
Golden Tree Insight Partners.
Golden Tree Insight Partners. I have to do it correct. Bruce Batkin, President of Terra Capital. And last but not least, a returnee, Matt Landau, Principal at Westport Capital Partners. So since you've been here before,
yes, sir.
You've been here also. So we were talking just before, how much money do you have to deploy? I just want to go around.
Okay. You want a short number? I want a 300 million-ish.
You have $300 million to deploy in real estate. Bruce?
We also have a couple of different funds. It's about 100.
So that's $400 million. Rob?
In the U.S., we have about $100 million left in our fund to deploy.
So I got 500 and...
We have another 300 million.
So I have $800 million. That's a lot of money. But you were saying that you hadn't done much in the last 2 years.
No, we made our first loan about 45 days ago, which was the first loan in 2.5 years. After, from 2003 to 2007, we put out about $2.5 billion. So for a couple of years, we saw no opportunity to put money to work.
What made this loan different? Why is today different than all other days for the last 2 years?
Well, I think you're starting to see lending institutions, whether it's a bank, insurance company, fund, finally look to unload legacy assets at market clearing levels. This particular transaction was a fund that gave our borrower the opportunity to buy back their debt at a significant discount. So we financed that transaction. And we were very comfortable at the basis we were at. We were well below replacement cost and getting what we think is a very opportunistic return on our capital.
Rob, before the show you were talking that your people like land and residential. Why do you like that today?
Well, similar to Scott, we hadn't made an investment in the U.S. Prior to third quarter of 2009 for about 2 years. Our last investment in the U.S. was in September of 2007. We like land for primarily been focused on single-family residential land for a couple of reasons. And it's really demographically and supply-driven. First of all, housing today is as affordable as it's ever been in terms of comparing the cost of carrying a home with mortgage, taxes, insurance to rental. Housing starts are at a 50-year low, 500,000 units a year versus historical of about 1.5 million to 2 million. Basically, when you look at, that's not even adjusted on a per capita basis. So when you look at scrapes, housing that's taken away and what's being built, and you look at the current supply, we believe, unlike what you read in the media about shadow inventory, foreclosures, that you could have a housing shortage potentially in late 2011. And the demographic trends with the echo boom, they're projecting 13 million people in the US, 2 per household, that's 6.5 million household creations.
Well, I'm not going to disagree with you, and I concur, but I'm going to tell you that there have been 2 major studies stating that many people who were buying homes, because they also this great appreciation, many people are thinking of remaining and paying for apartments because people went for the appreciation level because of the booms, that if you bought a house for $200,000, it was worth $400,000, and then you had the subprime market that you were able to refinance it and all the rest. But that is, there's a deep-seated feeling from the National Association of Realtors and some other economic people saying that people aren't going to be buying that quick. I'm agreeing with you, but there is this other thought out there.
When you look at the risks of what I sort of see as the risks in the industry are interest rates. That will change the affordability, but then you could argue that rents are going to go up as well because of supply. And also legacy issues in their current homes. How much velocity in trading can happen when people own mortgages that are more than their homes. So those are the 2 risks. But to your point, if you break down the different age groups and you look at historically, where most of the overabsorption, let's call it, in buying has been in the more senior cohorts, the empty nesters. That's why you saw a lot of the condo, going back to the city, whereas historically all the 25, 35, 45 has actually been lower than historical norms on the percentage of home ownership versus rentals. So that combined with the echo boom, we think the trends are interesting.
Bruce, what are you seeing? What are you doing? I mean, you're really the one guy who's truly a mezzanine lender, but I'd like, as opposed to me saying it, because my viewers, we don't like doing inside baseball, why don't you explain what a mezz lender is?
Sure. Well, the term mezzanine, as people know, means in the middle. So mezzanine lending is basically where the lender provides that capital slice, which is either in the form of a loan or in the form of a preferred equity position that is subordinate to the senior loan, to the first mortgage, which has the priority call on the collateral, and it is senior to the equity piece, to the borrower's piece. So for instance, in today's market, we will provide typically that piece of capital that's needed to acquire a building. That's anywhere from 60% of today's value up to 80 or maybe even 85% of today's value. The borrower will have to provide at least 15 to 20% of the purchase price of a building, and the senior lender typically today will provide somewhere around 60, maybe 65%. So we're in that middle band. That's the mezzanine piece. And the reason why we like that piece and why we focused on it since 2002 when we launched the company is that we can get, in our view, disproportionately high risk-adjusted returns.
Matthew, what are you guys doing these days? You got a couple $100 million sitting there. You bought property. You've made loans on hotels and other properties. You developed in Williamsburg.
Let's call it capitalism with a conscience.
We've been active. We doing green too?
We do green buildings. We've been active the last few years. We've been buying. We think there are always opportunities. We are trying to reflect our investors' needs, and our investors are primarily pension funds and college endowments. We don't buy rent-stabilized building trying to kick tenants out. We don't buy residential loans trying to kick people out. What we do is we buy loans that have been previously originated at deep discounts and then work out a solution with borrowers. That's been a very good business for us. We did make, over the last 4 years, 6 mezz loans, all paid off, except one we took the equity and are getting out whole. Currently, we're not really focused on the mezz slice. Our sweet spot is buying senior notes at a discount and either being paid off at a premium or par, or just owning the real estate. Our investors primarily pay us to roll up our sleeves, work the real estate, and create value by being able to move quickly and leverage the intelligence and the abilities we've developed.
I think you've led into a perfect question, and for my audience, because you talk about pension funds, you talk about college endowments and all the rest. Now, one of the items which I don't believe you're going to see happening, CalPERS lost a little money on Slytown, a lot of others, as you said, it's politically incorrect to buy residential rental and try to throw somebody out. So I don't see any of the major funds being happy to invest anymore in that market. Who are the type of investors, and how hard is it today to talk to a pension fund or an advisor about your platform today?
Well, I think a lot of the major investors that typically would hand funds to groups like ours have gotten hurt over the last few years. So they were, for a good amount of time, they were very tentative in terms of stepping back into the marketplace. But I think what you're seeing now is many of the more savvy investors are coming to the realization that it is time to step back into the market, that valuations have plummeted, and while no one's calling a bottom here, you can certainly make investments at deep discounts to historical values, and people are more willing to put money to work.
Now, for my audience, what's the minimum investment that an investor gives to you or to you? And
usually, our minimum investment depends on the fund and the opportunity we're raising capital for, but it's usually about a $10 million minimum investment.
And the maximum?
We have investors who have given us $400 or $500 million at a time.
Rob?
Our range is a little more broad. I would say the range to date of our investment's been about $1 million to $100 million.
Well, my range, as you know, is a lot broader than everybody else who's here, because we have a sleeve where we raise money from retail investors, where we take investments as small as $50,000. At the same time, we also raise money from institutions. Typically, that's a $5 to $10 million minimum.
I think my viewers and other people would be interested in this, the $50,000 to $100,000. Who comes to you? I mean, are they middle America? Are they people from all around? I mean, who's that type of investor?
Well, it's interesting. It is a cross-section. We raise money from retail investors nationally. And if you were to look at our book, you would see that we have investors practically in every state at this point. There happens to be a fairly big concentration in retirement areas, because we distribute a current dividend yield of 9% today, and we pay that monthly. We currently raise money from what are called accredited investors, people who have a certain minimum net worth and a certain minimum income, which entitles them to enter a fund like ours and take the risk associated with that. Our funds to the retail investors are sold through a network of about 50 broker-dealers around the country.
Mm-hmm. Matt?
We're not playing in the retail space. We've looked at it. It's both work. It just depends on what kind of firm you are. Investors tend to ask more questions today than ever. There's a large effort that goes into satisfying investors at every level, and we'd rather that number to be a $5 million minimum investor than smaller.
So here's my big question. Since everybody in different ranges is talking to investors, what do investors want to see? It's 2010, as you just alluded. Some of them got hurt a little bit for all the funds. I mean, Marathon's a great company. Things were too high. There was irrational exuberance. When you talk to an investor, what are they looking for? What type of deals? What's a sweet spot? What makes them happy to look to invest? What do they want to see?
I think first and foremost, they want to see real deals. They want to see that you have a real pipeline of transactions that are either closed or can close. Look, people invest money with us to get outsized returns. Outsized returns are, call it mid-teens type of return. We had not invested in kind of call it principal transactions, so we didn't see those returns available to us over the last 2 years. We recently closed on a transaction and have a bunch. We actually went to our internal credit committee yesterday on another transaction where we think we can achieve those returns and better. So I think far above anything else, if an investor has decided he's willing to step back into the market, when they come to talk to you, they want to see that you actually have done deals.
Besides doing deals, if I gave you $10 million, I mean, is it a 5-year hold? Is it 10 years? When could they get their money back? That's the question. I mean, Bruce was saying his investors get their 9% per month, and that's why they may be a large number of them are retirees. They're trying to do it like an annuity type of concept. Mm-hmm. An endowment fund has to, return. They have to pay the pensions off. They have other situations. When do they look to get the money back from you?
We're not a private equity fund, so we're a shorter term horizon. Most of our investments are kind of 3 to 5 year type investments. So you should, if you invest in a pool of these assets, should be getting a current return, monthly on those investments. Now your investment is locked up for a specific period of time.
How long is the lockup period?
It varies. The model for fundraising has changed, and many investors, we've done a lot in terms of managed accounts where people give us a large chunk of capital, and we tailor a specific investment program for them. So it could be a year, that could be 3 years, something along those lines. They may have an option to get out of uninvested capital after a certain amount of time. So the terms for an investor have gotten very flexible since the market downturn.
Yeah, I concur with Scott. What we're seeing investors look for is more targeted strategies, whether it's in a commingled fund with a direct strategy in, say, an asset class or some other metric, or managed accounts. I think you've also seen the pendulum of leverage swing to the investor. They're negotiating better terms. I would also think that consistent with going towards targeted opportunities, they're shortening up the investment period, the whole period. We are an private equity opportunity fund. So unlike a hedge fund, it does have a lockup period, but those periods are all tightening, so they see the horizon a little closer.
Matt?
Investors want what they always wanted. They want real returns. It's all about performance. It's just like a baseball game. At the end, somebody wins, somebody loses. If you're posting the numbers...
That's why I brought off 4 winners. I purposely didn't bring the losers.
Excellent. And everyone is trying to target strategies to investors. Our newest fund is a little over a year old. It's up over 30%. Our prior funds are returning all capital and a small promote. 06, 07 vintage wasn't the best time to be investing, but if you're protecting investors' capital, I think they recognize that and respect that. And going forward, it's just all about being able to source deals that some off market, a lot on market, but having the intelligence to filter them and pick your bets.
So here's a question. In the real estate spectrum, there are 4 different type of fruit classes. Let's say, there's multifamily, there's retail, there's office, and there's industrial, and there's hotel. There's 5. So, which ones in 2010? Because you're astute investors, you have well-seasoned organizations, you have the people over there. Which asset class do you like the best, and which one do you like the worst? I mean, I think that asking you is simple because you really were talking about you like for-sale multifamily.
For-sale residential. Mostly single family.
Scott, what would you think?
Well, I'll start by saying that the dearth of product available for investors today is hospitality and failed condominium developments, right? Because those were the 2 food groups that got kind of overbuilt and overvalued in the last cycle. So we see a lot of those opportunities. Hospitality is a major focus of ours. We think that from a bottom line perspective, the numbers have gotten crushed, and we think that as the economy improves, the hotel sector is going to bounce back the fastest. So if you can invest today at very low values, I think there's a big pop to come in that sector. The kind of condo sector is a little trickier, I think, because in many areas have been completely overbuilt, and there's you're competing against single-family residential, you're competing against rental development, so you have to pick and choose your investments wisely there and make sure that you can buy things correctly and kind of withstand the storm that's still not over, I think, in that area in terms of, if you buy something that you believe you're going to ultimately sell as a condo, you may want to be sure you can rent it for a while and make an okay yield while you do it. The other interesting sector I think that we've never been a player in, and we've have several opportunities in is retail. Retail typically, a developer would option a piece of land and then go out and sign a credit tenant and go finance it with that tenant's credit. So it would never come to guys like us to finance a transaction. And we have 3 deals we're looking at right now where the bank is kind of just, got hung with a development project midstream. Tenants were lost, tenants went bankrupt, and they just want to get out. So we're pretty bullish on certain retail locations or markets in the U.S. and are hoping to get involved in those sectors.
I agree, but we're also agnostic. We like a deal and its numbers, and there are also other types of areas to invest besides the 4 food groups. First of all, there's healthcare, and we have a portfolio of 40+ assets. We've purchased very cheaply, and it's a strategy that's worked well for us.
What type of healthcare? I think my audience would like to...
We've bought ALFs and SNFs. ALFs is assisted living facilities. SNFs are nursing homes. Generally under 30,000 a key. Great assets, broken balance sheets. So recapitalize a firm. You'll have operators out there who have half their beds or a quarter of their beds offline because they just don't have the capital to bring them online. But other than that, they're 100% occupied. So we like the healthcare space. We're watching carefully what's going on with legislation in Washington. We also buy derivative products. We bought CMBS. We continue to buy RMBS. And so there's a lot of different places to play in the capital stack, and you want to be flexible enough to adjust to wherever the yields are going. Last year they were in securities. This year they're coming back into the private equity, private asset play.
Bruce, of the asset food classes, what do you like?
We focus on the 4 major food groups, and although I agree with Scott, I see tremendous value growth potential in the hospitality sector. We tend to steer clear of volatile asset classes like hotels because they only have 24-hour leases. And so you have tremendous risk that, you have another 9/11 and all of a sudden the occupancy drops to 30% from 80%. So we can't afford to risk any cut in a dividend. And so we tend to focus on longer term leases, which are either office buildings, shopping centers, industrial facilities, or apartments, which may only have 1-year leases, but they tend to stay full.
The one thing that sort of concerned us at this time about some of the commercial asset classes, I agree with you on the hotels because everything is reset. You're at the bottom. We believe you're at the right part of the cycle when the transactions start coming. Some of the concerns we have about office and retail are, while you do have leases and it's great for a lender, for an opportunistic investors, you still have a lot of legacy old rents. So as they burn off, you could have a declining cash flow dynamic. And that combined with, basically office fills up not with GDP, it fills up with employment. And we're still at 9.7% employment rate. It doesn't look like it's going to bounce back quickly. All forecasts are for a very slow diminution of that. So we think office has risk, and there's so much capital right now chasing for the few deals. Everything is getting priced down to a 6 cap.
To echo Rob's point, leases, depending how they're written and who the tenant is, might help the tenant more than the landlord, because the landlord can't raise the rent during the lease term. But if the tenant's not credit, you know, and this case is all over America. They go back and they ask for rent reduction.
Right. What's very interesting,
it's like a baseball contract.
What happened last year is that many tenants went and wanted to see the strength of the landlord before they signed the lease, because that was the biggest problem. It wasn't that. I mean, people wanted to know that they were going to be taken care of, that the work would happen.
Although I just want to add one point. There's been really a sea change in the way senior lenders and mezzanine investors underwrite deals since 2007. I mean, the documentation was incredibly sloppy from 05 through 07, number one. Number two, the underwriting today, you set up enormous reserves, you adjust all rents to market, so the ultimate proceeds that are provided to a borrower today are heavily geared towards what current market conditions are.
But unfortunately, the big problem that I see is that, you know, when people get busy and when business prices go up there, lenders are, you know, putting their pants down a little bit, you know, giving a little more opportunities. I mean, I think the greatest example is, and everybody likes multifamily, but all of a sudden, you know, every bank wants to do multifamily, you know, at prices which are very low, which is great for a landlord, but it's dangerous. It's a difficult market. If we were sitting here 12 months from now, what would your crystal apples say? Well, where do you think the world is going to be a year from now? And it's hard for any of us. Matt?
I think a bit better, not significantly.
I think we'll look back at the end of 2010 and say there was a substantial amount of volume this year in terms of trading and refinancing and so forth, but that will all be concentrated in the second half of this year.
You know, I tend to agree with Bruce. I think there's going to be more activity. Lenders are transacting. Special services are. You're seeing debt come into the market a lot earlier than we all thought it would. So I think the second half of 2010 is going to be a lot more than the first half.
Yeah, I think all the signs point towards more activity. The credit is coming back, transactions are happening. So, you know, the second half of 10 will be more active. I actually think 2011 will be way more active than 2010.
You know, I don't want to end this on a sour note, but a couple of weeks ago I taped a couple of shows, and a number of the guests had told me that they had heard the chief economist from J.P. Morgan recently say that 2010 is going to be a good year, but 2011 is going to be a difficult year. And if that happens, you know, because of this rush over here, and then the world doesn't do that well, you know, you have Greece, you have other situations over here. I mean, fortunately, we had a terrorist matter that was taken care of. But if those things happen, you know, you really don't know what the market is. I'd like to thank Scott Schwartz, Rob Varadian, Bruce Batkin, and last but never least, Matt Landau. See you next week.
Major funding for this program is made possible by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, Inc., New York's window company, Capital One Bank, Greenberg Traurig, LLP. Additional funding for this program is made possible by grants from AVR Realty Company, LLC, Briarwood Organization, Beechwood Organization, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Hal Fettner, Durst Fettner Residential, First American Title Insurance Company of New York, F.J. Siami Construction, Friedman LLP, Gemini Real Estate Advisors LLC, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackel Realty Services, M&T Bank, Marcus and Millichap Real Estate Investment Services, Meridian Capital Group, the Moynihan Group, Margolin Weiner and Evans, LLP, Newmark Knight Frank, Orphanides and Associates, SJP Properties, Sterling and Sterling Inc., Stonehenge Partners, Urban American, the Witkoff Group.